Four major technology companies saw their cash flow fall below zero in 2026. That drop happened because they spent hundreds of billions of dollars on AI data centers. Critics warn of a debt bubble, while supporters see essential modern infrastructure. Is big tech overinvesting in AI? What's your opinion? Buy into the new tech foundations or fear a costly credit crash? In mid-2026, big tech cash flow fell to minus $94.6 billion. At the same time, their long-term debt doubled to $350 billion. This surge occurred because full-year infrastructure spending will reach $760 billion. Yet these tech firms also hold $1.68 trillion in future cloud orders. Amazon issued nearly $100 billion in bonds to build new facilities. Tom, does this massive debt spending build vital infrastructure or create a dangerous financial bubble?
David, big tech is driving directly into a dangerous credit trap. Capital spending across four hyperscalers will reach $760 billion this year. From my perspective, relying on heavy corporate debt leaves these platforms fragile. Their combined long-term debt doubled to $350 billion in 1 year. That massive outlay pushed their cash flow to minus $94.6 billion. Operating cash generation simply cannot keep pace with such extreme building costs. Borrowing money for digital hardware is like buying appliances on a credit card. If market revenue slows down, those fixed debt payments still must be paid. What requires serious scrutiny is the actual quality of their sales backlog. Unprofitable research labs like OpenAI and Anthropic hold much of that cloud backlog. Meanwhile, enterprise clients report rising adoption costs and failed software pilots. Many companies struggle to turn early AI experiments into profitable daily tools. If corporate customers stop paying, those startup commitments will unravel very quickly. That crash would leave hyperscalers holding empty and deeply unprofitable data centers.
Tom contends that debt-funded expansion leaves technology giants exposed to market shocks. He warns that unprofitable startups cannot guarantee long-term cloud revenue. Emily, how do you defend this massive infrastructure spending?
David, these spending figures reflect real customer demand rather than empty speculation. Major cloud providers hold a combined order backlog of $1.68 trillion. Amazon Chief Executive Andy Jassy confirmed that server capacity remains insufficient through 2027. Data centers are like modern power plants that must be built before electricity flows. Building capacity early prevents severe shortages when business demand surges. Without expanded data infrastructure, enterprise customers could face severe service delays. Furthermore, these heavy capital outlays are already generating massive annual revenue streams. Amazon earns over $25 billion each year from its custom AI processor chips. Customers choose proprietary chips because they lower computing costs significantly. Microsoft saw its quarterly cloud business revenue growth reach 40%. That surge added $448 billion to its value in 1 day. High capital investment is delivering clear commercial returns to major platform operators. That proven growth demonstrates that hardware spending directly fuels new market expansion.
Emily argues that massive capital spending directly addresses structural computing shortages. She emphasizes that growing cloud revenues prove strong commercial return on these investments. Tom, how do you view these strong order figures and rising revenues?
I agree that cloud order backlogs are large and short-term computing capacity remains tight. That logic is sound, but it ignores severe warnings from credit markets. Credit default swap prices for major technology firms reached record highs in mid-2026. Lenders fear that massive borrowing outpaces cash generation from daily operations. Investors sold long-dated debt because rapid technological progress makes older chips obsolete. Computer chips lose value far faster than traditional utility assets like bridges or rails. As a result, Meta saw its 10-year bond yields climb to 5.8%. Its 30-year bond yields reached approximately 7%, amid continuous debt issuances. Higher borrowing costs reduce future profitability for every new computer center. Rising interest rates prove that financial markets view this debt boom as dangerous.
Tom acknowledges high current demand, but highlights severe warning signs in bond markets. He argues that rising debt yields show investors fear rapid hardware obsolescence. Emily, how do you explain these escalating credit market risks?
I concede that tech firms face negative cash flow and rising debt burdens right now. However, massive initial outlays represent the normal life cycle of foundational utility construction. Historical infrastructure booms like telegraph and electricity networks required huge upfront capital. Power lines and cables were built years before primary consumer applications fully materialized. Today's data center expansion forms the essential backbone for tomorrow's digital economy. Digital networks require patient capital long before software tools generate steady profits. Amazon issued nearly $100 billion in bonds to finance durable data facilities. Alphabet raised $85 billion through equity without creating excessive credit risk. Equity funding provides long-term stability because it does not require fixed interest payments. These diverse financing methods allow tech platforms to absorb temporary financial pressure. Strong balance sheets give hyperscalers the strength to finish this vital construction phase. Building essential computing power today ensures lasting economic growth for decades ahead.
This debate brings us back to today's central infrastructure question. Hyperscalers are pouring record sums into new physical data networks. Does this massive AI spending represent a rational utility build-out backed by durable demand? Or is it an unsustainable credit bubble driven by circular startup commitments? History shows that telegraph and electricity networks required enormous capital before applications arrived. Early investors often suffered losses, yet the underlying infrastructure permanently transformed global commerce. To judge this expansion, watch one clear indicator over the next 6 months. Real market outcomes will soon show if this debt surge was justified. Track whether hyperscaler cash flow recovers as enterprise pilot programs turn into paying clients. Alternatively, check if credit default swap spreads and bond yields continue to rise. If debt yields keep climbing, financial markets will force a sharp spending slowdown. The answer depends on whether computing demand produces real earnings before borrowing costs overwhelm platforms. Now it is your turn to practice 3 key debate frames. First, use this phrase to enter the discussion with a clear opinion. From my perspective, long-term stability matters more than rapid growth. From my perspective, borrowing heavily creates unacceptable financial risks. From my perspective, building early infrastructure secures future industry leadership. Second, use this frame to emphasize an important point that needs attention. What requires serious scrutiny is how quickly enterprise software adoption spreads. What requires serious scrutiny is whether startup order commitments stay reliable. What requires serious scrutiny is who absorbs the ultimate cost of hardware. Third, use this pattern to concede a point before offering your rebuttal. That logic is sound, but borrowing costs are climbing rapidly. That logic is sound, but customer adoption remains unproven in practice. That logic is sound, but physical data centers depreciate very fast. Try using one of these expression frames in the comments below. Thank you for watching the Breakfast Debate, and see you next time.